Hello aspirants, I'm Siddharth Gautam, Faculty of Indian Economy. So as part of the rapid revision program that we are providing for you, we are going to discuss the next chapter in the economy, that is the monetary policy. The monetary policy and the banking in India. Okay, now what is monetary policy? What do you understand by the term monetary policy? See, monetary policy is nothing but it is the instrument. It is the instrument or it is the strategy that is employed by the central bank, that is the RBI, to regulate the money supply, and interest rates. Okay, so if there is an increased money supply in the market, if the money supply in the market is not regulated by the RBI, what will happen? It will lead to the inflation. Okay, and if the interest rates are not regulated in the market, it will lead to the crowding out effect. The crowding out effect. Crowding out effect is nothing but because of the prevailing high interest rates in the market, because of the high prevailing interest rates in the market, the private players will not find the options of investment. The private players will not get or will not able to mobilize their investments from the market or the banking system, etc. So that is the reason because of which they tend to withdraw their companies, or they tend to demotivate, and as a consequence of that there is no demand or there is no growth. That is the reason because of which the money supply and the interest rates need to be regulated in the market, and that strategy is employed by the RBI, that is the central bank. Okay, now the Reserve Bank of India formulates and implements monetary policy. See, the fiscal policy is regulated by the government, and the monetary policy is regulated by the RBI. You need to remember this. Okay, see, the monetary policy is not regulated by the government. The monetary policy is regulated by the RBI to maintain price stability, ensure economic growth, and stabilize the financial system. See, price stability, I have told you, because if there is no price stability, if there is increased prices, it might lead to inflation. Okay, or if there is decreased prices, it might lead to deflation. And to the economy, or to an economy, both inflation and deflation are not good. They are not good for the stability of the economy. That is the reason because of which, to maintain the price stability, ensure economic growth, and stabilize the financial system. Clear? Next. So here the question can be asked in such a way that the monetary policy is regulated by which of the following. Okay, the questions may not be that direct, but at least in a confused statement, this particular question can be asked. And the objectives of the monetary policy, which is to maintain the price stability, ensure economic growth, and stabilize the financial system. So the question can be asked from the objectives, or the questions can be asked from the who regulates or who formulates the monetary policy. Clear? Next. Now, the objectives of the monetary policy. First one, economic growth acceleration. Economic growth acceleration is nothing but for the economic expansion. There is enough credit or not? There is enough credit or not? Is there the enough availability of the money for the economic expansion? Okay, if there is no enough credit, or there is no investments within the market for the economic expansion or the economic growth, then the economy will not develop. There is no growth in the economy. That is the reason because of which RBI adopts two kinds of policies. One is the expansionary monetary policy and the contractionary monetary policy. Expansionary monetary policy is nothing but to make it sure that there is enough money in the market, and if there is no enough money in the market, RBI will inject money into the market through certain instruments. That is what is called as the expansionary monetary policy. Whereas we have the contractionary monetary policy. Contractionary monetary policy is nothing but if there is increased supply of money in the market, and if the RBI wants to squeeze out that money out of the market because of the rising inflation, then that is what is called as the contractionary monetary policy. Clear? Next, the price stability. See, the price stability can be achieved through the contractionary monetary policy. The price stability can be achieved through the contractionary monetary policy. Contractionary monetary policy focus on the squeezing the money out of the market so that the inflation can be reduced, the prices, increasing level of prices can be decreased. Clear? Next, exchange rate stability. Exchange rate stability. Now, the RBI is mandated to manage the fluctuations, the currency fluctuations of rupee, the currency fluctuations. Clear? Next, balancing savings and investments. Balancing savings and investments. See, the another aim of the RBI is to increase the savings rate, is to increase the total savings rate. Okay, that savings, that money deposited within the banking system can be used as the money to lend to the other players who will invest that money in their companies or in their entities, so that there is economic growth, there is availability of funds, and also there is savings. Clear? Next, employment generation. Employment generation, supporting sectors that create job opportunities by providing them the investments, Clear? So, in this area, the question can be asked in such a way that what is contractionary monetary policy or what is expansionary monetary policy, and what are the effects of the contractionary monetary policy and what are the effects of the expansionary monetary policy, and how contractionary monetary policy and expansionary monetary policy leads to the increase or decrease in the inflation, or how it regulates the concept of inflation, and also how the RBI manages the exchange rate system, and also what is the use of increasing savings rate and also the employment generation. Clear? Next. Now, the key terminologies in monetary policy. The key terminologies in the monetary policy are the instruments that are employed to regulate monetary policy, to regulate the monetary policy. The first one is the bank rate. The bank rate. Bank rate is nothing but the rate at which RBI lends long-term funds. Long-term funds. Bank rate is nothing but it is the rate at which the RBI lends the long-term funds to commercial banks to manage money supply. Okay. If the commercial banks have the crunch of liquidity, if the commercial banks have no money with it, then it can lend the money from the RBI at bank rate on long-term basis. The keyword here is the long-term basis. This is the keyword. Clear? So, if there is if there is a crunch of liquidity, or if the banks are suffering with less amount of money, the money can be borrowed from the banks RBI on long term basis through bank rate. Next, liquidity adjustment facility. Liquidity adjustment facility. It is a tool used by bank to manage short term liquidity mismatches through borrowings from the RBI. Okay, if the liquidity is short term in nature, if the liquidity mismatch is very short term in nature, then that short term liquidity mismatches can be supplemented by borrowing the money from the RBI on very short term basis. On short term basis, as it is the the short-term liquidity mismatch, the money can be borrowed from the RBI on short-term basis. Next, the repo rate. The repo rate. The repo rate is nothing but it is the fixed interest rate. Mind this word, fixed interest rate. at which the RBI lends short-term funds to banks against government securities. Repo rate is the fixed interest rate at which the RBI lends money to the banks at fixed interest rate on short term basis, on very short term basis. That is what is called as the repo rate. Okay. Now this serves as the policy rate influencing market lending rates. For example, if there is a RBI, okay, now RBI is giving the money to the banks on very short term basis. Okay. Now if the repo rate is increased, it means that RBI is charging high interest rate, where the banks need to pay high interest rates to the RBI. For the bank that need to pay high interest rates, it need to earn more profits. Okay. So for that purpose, the interest rate that is given to the depositors might decrease, or the interest rate that is fixed on the people where the bank is giving money, bank is providing loans, might be increased. Okay. So the repo rate will influence the the policy lending rate of the banks. Okay. The policy lending rate might increase. Clear? And the another thing is that repo rate will have the effect on the inflation also. Why? Because if the RBI wants to decrease the circulation of money in the market, the repo rate will be increased. The repo rate will be increased. As a consequence of the increased repo rate, the inflation in the market might be decreased. It will have the effect on the circulation of the money. So as a consequence of that effect, the money circulation in the market will be reduced, and the inflation will be reduced. Clear? So here the questions can be asked in such a way: what is liquidity adjustment facility? Okay, or what is repo rate? Is repo rate a short term interest rate, or the long term thing that is imposed on the banks, or can banks borrow the money on short term basis or the long term basis? That is one question. And the other question is that what is the effect of repo rate on the inflation? What is the effect of repo rate on the inflation? Will the inflation decrease if the repo rate is increased, or there is a direct proportionality or the inverse proportionality with respect to the repo rate and the inflation? Clear? Next. Now, reverse repo rate. Reverse repo rate. Reverse repo rate is nothing but RBI taking loan from the banks. Okay, the rate at which banks lend surplus funds to the RBI for the exchange of securities, helping to absorb excess liquidity, See, for example, there is a RBI. Now, banks lending to RBI, it means that the excess liquidity in the market is taken out by RBI. The excess liquidity in the banks is squeezed by the RBI. Now, as a consequence of excess liquidity being squeezed by the RBI, it means that the circulation of money in the market is decreased. As a consequence of that, it is leading to the decreased inflation. Clear? Next. Marginal standing facility. See, marginal standing facility is nothing but a borrowing window for banks to access emergency liquidity from the RBI at rate higher than the repo rate. If there is an emergency situation, then there is a window that is facilitated by the RBI to the banks, where the banks can lend the money from the the RBI at the rate more than the repo rate. At the rate more than the repo rate. That is what is called as the marginal standing facility. Next, monetary policy corridor. It is defined by the marginal standing facility rate, which is nothing but the upper limit. Okay, and also the lower limit. Okay, which is nothing but the reverse repo rate, which is influencing the daily liquidity conditions in the interbank thing. Clear? See, for example, monetary policy corridor is nothing but there is a marginal standing facility where the money is available at the rate which is higher than the repo rate, and there is a lowest rate which is the reverse repo rate. The entire process, the entire, what do you say, this range from high to low is what is called as the monetary policy corridor. Clear? Next. Now, reserve requirements. Reserve requirements. This is very important. Okay. See, in the past slide, in the previous slide, the question can be asked how the reverse repo rate will influence the inflation. Point number one. Point number two, what exactly is the marginal standing facility? How does the marginal standing facility is different from the repo rate? Okay. And the monetary policy corridor. Okay. What are the, what is a range, what is the range that is taken for calculation of the monetary policy corridor? Clear? Next. Now, reserve requirements. The first one is the cash reserve ratio. Cash reserve ratio. Cash reserve ratio, nothing but it is the CRR. It means that the percentage of the bank deposits that must be maintained as reserves with the RBI in cash form. Okay. For example, if the banks are getting the deposits, okay, in the form of NDTL, net demand and time liabilities, then that part of the thing need to be kept with the RBI. Okay. Certain percentage of the money of the deposits of this thing should be kept with the RBI in the form of cash. That is what is called as the CRR. If the CRR is being increased, it means that the inflation is being regulated. If the CRR is increased, it means that the inflation is being regulated. If the CRR is decreased, it means that there is a expansionary monetary policy that is being followed to expand the liquidity, to increase the liquidity. Clear? Next. Statutory liquidity ratio, which is nothing but the SLR, the statutory liquidity ratio. See, the portion of the deposits that banks must maintain in liquid assets like government securities, gold and public sector bonds. The bank need to diversify its assets. Okay. The bank need to, what do you say, diversify its deposits. Okay, not assets, deposits. Okay. So, statutory liquidity ratio is nothing but it is a system where the bank is mandated to maintain certain percentage of its deposits in the form of the diverse liquidity, what do you say, things like the gold deposit, the securities, government securities and the public bonds. Clear? Next, liquidity coverage ratio. Liquidity coverage ratio. Liquidity coverage ratio is nothing but a requirement ensuring banks to hold enough high quality liquidity assets. High quality liquidity assets. Okay. If the bank for its maintenance for next 30 days, okay, for its maintenance for next 30 days without keeping itself in any risk, it need to maintain certain assets in the form of the high quality liquid assets. High quality liquid assets, that is what is called as the liquidity coverage ratio. But remember here one thing, the question here might be asked in the context of CRR, how CRR will influence the inflation. What is CRR? Is CRR maintained only in cash or are there any other means of maintaining the CRR? First one, does CRR earn any interest? No. And also the CRR will influence the inflation by, what do you say, if the CRR is being increased, it means that it is a contractionary monetary policy and the excess circulation of money in the market is squeezed out. And if the CRR is being decreased, it means that it is the process of the expansionary monetary policy where the money is being injected into the market or we are facilitating the circulation of money in the market. Next, statutory liquidity ratio. Statutory liquidity ratio is nothing but it will The question can be asked in a way that is there, what do you say, is it mandatory for the banks to maintain SLR? Point number one. And point number two is that what are the ways through which the statutory liquidity, what do you say, ratio can be maintained? Okay, what are the instruments? Next, the liquidity coverage ratio. Clear? Okay, next. Now, liquidity management mechanisms. Liquidity management mechanism. Liquidity management mechanism is nothing but how do we manage liquidity? See, for example, there is a thing called as the standing deposit facility. Okay, it is the collateral free mechanism. This is the key word. The collateral free mechanism that allows the RBI to absorb excess liquidity without offering government securities. Okay, see, SDF, standard deposit facility, is nothing but, see, generally when the government or when the RBI or any entity, if they want to take the loan from anywhere, they need to give a collateral in the form of the government securities or in the form of the bonds. But here the RBI is trying to extract the money from the market where there is increased circulation without any collateral. Without any collateral or without any government securities. That is what is called as the standard deposit facility. The aim of the standard deposit facility is to decrease the liquidity, is to control the liquidity, is to decrease or the control liquidity. Clear? Next, open market operations. Open market operations. Buying and selling of government securities by the RBI to regulate money supply. There is a market where there is an increased circulation of the money. Okay. Now, what does the RBI do is that RBI will have the securities, the government securities are the bonds with itself. Now, that bond is sold into the open market. Okay. Now, here there is a collateral. The collateral is the bond. Okay, the RBI is pledging the bond, the RBI is pledging the government securities so that the excess liquidity in the market can be squeezed out by the RBI. That is what is called as the open market operations. Next, market stabilization scheme. Market stabilization scheme. Now, market stabilization scheme is nothing but it is the instrument, okay, that is used by the RBI to absorb the liquidity from the market by issuing short-term bonds, by issuing the short-term government securities. Here the key word is the short-term. Clear? So, in the market stabilization scheme, the money is being, what do you say, squeezed out of the market by the issuance of the short-term government securities. Next, the long-term repo rates, the long-term repo operations. Now, if you remember, as part of the repo rate, we have discussed that it is the rate at which the RBI gives money to the banks. RBI lends money to the banks on the short-term basis. Okay, but the long-term repo operations is nothing but the provisions of long-term funds by the RBI at the prevailing repo rate against government securities. Okay, the long-term repo operations. It is not short-term, but it is the long-term repo operations. That is what is called as the LTRO. Clear? Now, here the question can be asked whether the standing deposit facility is the collateral free or is it collateral based. Okay, and open market operations, the idea of open market operations can be facilitated in what way? Next, the market stabilization scheme, whether the market stabilization scheme happens or performed through short-term government securities or the long-term government securities, and the LTRO, the long-term repo operations. Obviously, within itself there is a mention of the word called as the long-term. So, obviously, you will understand, but you need to understand the time frame, that is 1 to 3 years. Clear? Next. Now, interest rate mechanism. Okay, see, within the interest rate mechanism, you have certain methods called as the hawkish monetary policy. Hawkish monetary policy. Hawkish monetary policy is nothing but to curb the inflation by increasing the interest rates. By increasing the interest rates. For example, there is a bank, okay, and there is increased money supply in the market. Okay, now the banks wants to decrease the money supply in the market. Okay, now what does it do? It will attract its customers, it will attract its depositors to deposit the money in the banks. Now the banks will say that we will offer you the high interest rates. Now if you deposit the money in the banks, we will offer you higher interest rates, so that many of the people, they will attract to deposit that money in the bank, and as a consequence of that, the interest rate is being provided high by the bank, so that the inflation can be regulated. Next, dovish monetary policy. Dovish monetary policy. It is a monetary policy. It is aimed at boosting economic growth by reducing the interest rates. Okay, now the banks don't want people or the depositors to deposit money in the banks. Okay, they want the money to be spent, they want the money to be held by the public, so that the money can be used for the spending purpose, leading to increased demand, leading to increased growth. Okay, next, benchmark prime lending rate. Benchmark prime lending rate. It is the system where banks offered loans at their benchmark rate to the most credit worthy customers. Okay, the most credit worthy customers, or who are disciplined in paying the loan on timely basis, on regular timely basis, for them the money is provided at the benchmark rate. That is what is called as the benchmark prime lending rate. Next, base rate. The base rate. Base rate is nothing but the minimum interest rate. The minimum interest rate at which banks could lend to customers. Okay, so it is the marginal cost of lending rate. Marginal cost of lending rate. It means that below that rate, okay, that is the minimum rate at which the loans need to be provided, and it cannot fall beyond that. It cannot decrease beyond that. That is what is called as the base rate. Now presently it is called as the marginal cost of funds based lending rate. Clear? Where it is the minimum rate. If, for example, if the 4% is the minimum rate, now it is not allowed to fall beyond that. It is not allowed to fall beyond that. That is what is called as the base rate. Next, marginal cost of funds based lending rate, MCLR. We call it as the MCLR. Okay. Now it is based on the loan tenure of the particular loan that is scattered to the any particular person or the entity. The minimum lending rate will be decided by the banks. It is not decided by the RBI, but it is decided by the banks. Banks individually decide what is the minimum lending rate that can be determined by banks based on the loan tenure, by the loan tenure. Clear? Next. So here the question can be asked, what is the hawkish monetary policy? Is it expansionary monetary policy or the contractionary monetary policy? It is the contractionary monetary policy. Whereas dovish monetary policy, it is the expansionary monetary policy. Next, benchmark prime lending rate. Okay, so it is the rate at which the loan is scattered to the credit worthy customers. Next, the base rate. Base rate is nothing but, previously we used to call it as the base rate because it is the rate at which, below which the money cannot be lent to the any particular person or the entities. That is replaced by the marginal cost of funds based lending rate. Clear? Next. Now, inflation targeting framework. Inflation targeting framework. This is very important. Why? Because this comes in the context of the Monetary Policy Committee. Monetary Policy Committee. Clear? Now, what is inflation? Inflation is nothing but increased supply of money in the market, which leads to increased prices of goods and services. Clear? Now, when it is considered as the increased supply of money in the market, which is leading to the increased prices of goods and services, then one thing that we need to understand is that what is the optimum level of inflation? What is the optimum level of the inflation? Optimum level of the inflation is nothing but how much percentage of inflation is wise for the government or for a particular economy. For the economy to stabilize, for a economy to progress, what percentage of inflation is wise? Is it 0%? Or the inflation can be 2% or 4%. What is the thing? Now, according to the Monetary Policy Committee that we have set up, the optimum level of inflation in India is 4%. It is 4%. Okay. Now, you might get a doubt. When the inflation by itself denotes that it is the increased level of prices of goods and services, how can 4% of inflation can be optimum? It should be 0, right? There should not be any increase in the price of goods and services. See here, inflation sometimes is healthy to the country. It is healthy to the economy. Why? Because there is a increased, a demand, there is a little increased demand and there is a little increased supply according to that demand, and there is a growth because of that mismatch. Okay. The mismatch can happen little. There can be a little mismatch. Clear? Now, the inflation, it is targeted at 4%. Okay, but there can be a relaxation of plus or minus 2%. Okay, to the peak level, the inflation can grow, can increase up to 6%, but that is only can be happen only when there is some kind of economic instability, some kind of factors like the COVID, etc. And it can decrease to 2%, but decreasing beyond 2% is also not wise for the economy, not good for the economy. Okay. So, this target is recommended by the Urjit Patel Committee in 2014, in the year 2014. Next, inflation targeting strategy. Okay. So, when we have discussed the fiscal policy, I have told you directly or indirectly, the targets of fiscal policy and the targets of monetary policy are more or less same. Okay. The fiscal policy aims to target the inflation by the system of taxation. The instrument used is the system of taxation, and whereas the RBI targets the inflation through many of its instruments like the repo rate, CRR, and etc. Okay. So, there is it is a responsibility of both the fiscal policy and the monetary policy to regulate the inflation. Okay. Next, Monetary Policy Committee. The Monetary Policy Committee, the body responsible for setting benchmark interest rates to meet inflation targets. Okay. So, it is the body responsible for setting the benchmark interest rates to meet the inflation targets. Okay. How the inflation can be curtailed by increasing interest rates, how the inflation, how the expansionary monetary policy can be promoted by decreasing the interest rates. Okay. The amount of the money that is held by the public can be increased or decreased to regulate the inflation. Okay, to facilitate the circulation of the money, the expansionary monetary policy can be promoted, or to decrease the circulation of the money, the contractionary monetary policy can be followed through Monetary Policy Committee. Now, here the question can be asked in a way, what is the target of the inflation with respect to the Urjit Patel Committee appointed in the year 2014? Next, inflation targeting strategy. Okay. Is it the responsibility of only the monetary policy to target the inflation, or it can be the responsibility of both the monetary policy and the fiscal policy to target the inflation? Next, the monetary policy committee, the recommendations of the monetary policy committee. Clear? Next. Now, twin balance sheet. Twin balance sheet is nothing but it is the problem where the NPAs are increasing, the NPAs are increasing, and also the company's growth is decreasing. The company's growth is decreasing. Okay, certain companies are given excessive amount of loans. They have been overly leveraged. They have been overly leveraged. Okay, but these companies over the time, because of the lack of output or because of the lack of growth, or they running into losses, they cannot pay that money or they cannot repay that money to the banks, leading to the NPAs, non-performing assets. Okay, so they are considered as the bank loans. Sorry, the bad loans. Okay, so the business burdened with excessive debt struggle, okay, to meet loan repayments. Okay, there is a company, that company has been given loan by the bank, but that company is not performing well and it is burdened. Now, as a consequence of this burden, the loans that are given by the banks, considered now as bank loans, bad loans, are not repaid back to the banks, leading to the increased NPAs. Okay, so if there is a company, if I am the bank and if there is a company, I am giving loan to that company, but the company's output is not good. Okay, so the debt level is burdened. The debt level is being burdened by the particular bank, and as a consequence of that, the NPS in the banks are rising, leading to twin balance sheet problem. Okay, now the NPA for the entire banking sector is around 9%. Okay, and the NPA for PSBs, the public sector banks, is for 12.1%. You need to remember that there are high NPAs in public sector banks. Public sector banks. Clear? So a direct question can be asked, what is twin balance sheet problem? Okay, or the twin balance sheet challenge. Clear? Next. Now, solution to the twin balance sheet challenge. First one is the public sector asset rehabilitation agency. Okay, it means that company which is running into losses, okay, can be attached to any rehabilitation agency where at least the growth can be revived. The growth can be revived. Or that particular company can be put into auction so that at least certain percentage of the loan can be recovered. Clear? Next, incremental cash reserve ratio. Incremental cash reserve ratio. Incremental cash reserve ratio is nothing but sometimes the bank or the RBI can ask the banks to deposit 100% or majority percent of their deposits with the RBI in the form of CRR. Okay, this especially happened during the demonetization. Okay, incremental CRR is nothing but an additional reserve requirement imposed on banks for managing sudden liquidity surges. Sudden liquidity surges it happened during the time of the demonetization, where the entire amount that is deposited in the bank is taken away by the RBI in the form of the CRR. Clear? Next. Now, special concepts in the banking and monetary policy. Okay, the first one is the helicopter money. Helicopter money. Helicopter money is nothing but to boost the growth. Okay, to boost the growth or to increase the money supply in the market, the RBI printing the money, RBI printing the new currency and injecting that new currency in the market. Okay, it is an hypothetical situation. It is a hypothetical monetary policy tool where the central bank print and distribute the currency in the public to boost demand. Okay, it is a what is a example of the expansionary monetary policy. Okay, next, the liquidity trap. Liquidity trap is a situation where the monetary policy becomes ineffective due to ultra low interest rates, causing people to hoard cash interest instead of investing. Okay, so it is a situation where the public is not interested to deposit the money in the bank. It is a situation where the public is interested to hold the money in their own hand or in their own household by not, what do you say, depositing the money in the financial institutions like the banks. Now, as a consequence of that, the banks will not have the money in order to provide them as the loan to the market or any person in the market. So, that will create a liquidity trap where the asset is not built up by the banks. Okay, the deposits will be used by the banks to provide the loans, and that profit that is earned out of the loan is the profit of the profit of the banks. Now, there is no profit to the banks because of the liquidity trap. Next, central bank digital currency. Central bank digital currency. Okay, now it is a digital version. It is a digital version of the fiat currency. Okay, that is issued by the central bank to enhance financial security and cross-border transactions. It means that the money is held in digital form. The money is not held in the physical form. As a consequence of money being held in digital form, you can carry out the transactions anywhere by using the digital platforms. Clear? Next, stable coins. Stable coins. Okay, stable coins are nothing but the cryptocurrencies which are pegged to stable assets like the fiat currencies to reduce price volatility. Okay, the cryptocurrencies are pegged. Pegged means equaled. Okay, the value of the cryptocurrency is equal or is being compared to the any prominent international currency or any prominent fiat currency is what is called as the stable coins. Next, unified lending interface. Unified lending interface. It is nothing but a platform for seamless digital lending modeled after UPI to integrate loan related data for faster approvals. Okay, the number of loans that we have shall be digitalized so that there is a feasibility with respect to the data that can be acquired or the feasibility with respect to the prompt repayment of the particular loans. Clear? Now, role and functions of the Reserve Bank of India. Okay. See, the RBI was established in the year 1935 under the RBI Act 1934. Okay, but it was nationalized in the year 1949. And from 1949, it operates as the central bank. It operates as the central bank under the Central Board of Directors. There is a board of directors with respect to RBI, and the policy decisions used to be taken by this board of directors. Clear? Next. Now, key functions of the RBI. This is very important. Why? Because majority of the times the questions are asked from this area. The key functions. The first one is the bank of issue. The bank of issue. RBI has the sole authority to issue the Indian currency notes, while coins and one rupee notes are distributed on behalf of the government of India. All the currency notes are issued by the RBI except the coins and 1 rupee notes. 1 rupee notes. Okay, the coins and the 1 rupee notes are distributed by the RBI on behalf of the government of India. Clear? This is one thing that you need to remember carefully. Next, banker to the government. Okay, the government transactions and public debt. In order to supplement to the government transactions and the public debt. For example, in when we discuss the monetary policy, at one point of time, I have discussed this concept called as the monetized deficit, the budget deficit. Okay, though they have been discontinued, the monetized deficit and the budget deficit have been discontinued. Still, there is a possibility of these things to happen because of RBI being the banker to the government. Okay, if the government have the liquidity shortfall, then the money can be lent from the RBI against the government securities, against the collateral. Clear? Next, bankers bank and lender of last resort. Bankers bank and the lender of last resort. It means that the banks, the scheduled commercial banks or the other banks where there is a shortfall in the liquidity, where there is a small mismatch in the liquidity, or when there is a repo rate that need to be induced, then that banks will borrow the money from the RBI at the repo rate. Okay, so the RBI is being the lender to the banks. That is the reason it is called as the bankers bank and lender of last resort. Okay, next, credit controller. Credit controller, the supply of credit can be regulated in the market through monetary policy tools. The supply of credit can be regulated or can be controlled. Clear? So here the question can be asked, what are the notes or what are the currency that is issued by the RBI, how it becomes the banker to the government, okay, and how it is considered as the bankers bank and the lender of last resort and the credit controller. Clear? Next. And also the government's agent and advisor with respect to the finances. Okay, the issuance of the government securities or the treasury bills, which are considered as the T-bills or the rediscounted bills. Okay, and advises on the financial matters. Okay, the government securities and the T-bills are issued by the the RBI. Next, National Clearing House. National Clearing House. The interbank settlements are facilitated by the RBI for the banking transactions. Clear? Next, the custodian of the forex reserve or the foreign reserves. The foreign reserves in the form of the most prominent currencies. Okay, the foreign reserves in the form of the currency assets, like the most prominent currencies like the yuan or the dollar, euro, etc. See, why do we call them as the most prominent currencies is because these currencies are used in the exchange system. Okay, these currencies are used in the process of the trade. Okay, the majority of the global trade happens through these currencies. That is the reason because of which they are considered as the forex reserves. The amount of reserves need to be high with respect to the government because these reserves can be used for the trade. Okay, and also the gold reserves and the IMF special drawing rights. Clear? Next, we will discuss what is IMF special drawing rights when we discuss the concept of the IMF. Don't worry. Next, supervisory role. Regulates commercial and cooperative banks. The commercial and cooperative banks are regulated by the RBI. Okay, the commercial and the cooperative banks need to function within the guidelines of the RBI. Okay, because the financial stability of the country, majority of the financial stability of the country depends on how the cooperative and the commercial banks function. That is the reason because of which the supervisory role is played by the RBI with respect to this. Next, promotional functions. Promotional functions. encourages banking penetration for the financial inclusion through the certain institutions, like the FCA, IFCI, SFC and the IDBI. Clear? Next. Here the question can be asked in the same way. Okay, what are the things or the duties performed by the RBI, or what is the supervisory role of the RBI? Clear? Next. So this is with respect to the entire the monetary policy system, and the conclusion is that the things play a crucial role. The monetary policy plays a crucial role in achieving the economic stability, in regulating the inflation through different instruments, okay, by regulating the lending rate, so that the liquidity in the market is regulated. Clear? So the areas that we need to focus as part of the monetary policy is that the objectives of the monetary policy, especially what exactly is the monetary policy. Next, the objectives of the monetary policy, the instruments that are used by the RBI to regulate the money supply in the market, the recommendations of the Urjit Patel committee with respect to the what is the optimum level of inflation rate. Okay. Next, different terminologies with respect to the RBI, etc. Clear? So let's move on to the next topic as part of this session, that is the inflation. Clear? Now, what is inflation? What do you understand by the term inflation? Inflation is nothing but it is the general rise in the prices of goods and services. Okay, if the prices of goods and services increase over the time, that is what is called as the inflation. Okay, now what are the causes of inflation? What are the causes of the inflation? The first cause is the demand pull inflation. The first type of the inflation is the demand pull inflation. Demand pull inflation is nothing but if the consumer spending increases over the time. Okay, if there is an increased circulation of money, and as a consequence of that, if the demand is increased, over the time, then that leads to the demand pull inflation. So it is fueled by rising wages. Clear? So if there is an increase in the wages, if there is an increase in the salaries, the person will have the more money in his hand to spend. Now, as a consequence of him having more money to spend, he will use that money for the purpose of the consumption, and the goods of that consumption will increase. The prices of those essential goods will increase over the time. That is what is called as the demand pull inflation. Demand pull inflation is the scenario where the prices of goods and services increased because of the high demand that is created within the economy because of the increased wages or the decreased supply of that particular good. Next, cost push inflation. Cost push inflation is the scenario where if the general cost of production, if the cost of production increases, that cost of production will be reflected in the final price of the particular good. For example, the prices of the raw materials has increased. Now that will be reflected in the final prices of the good. Okay. So if the tariffs have been increased with respect to the raw materials that we are importing from the other countries. Okay. Now even that time the price of the final product will be changed. That is what is called as the cost push inflation. Happens where companies face higher production cost, example raw materials or the labor, etc., and pass this increased cost on to consumers in the form of high prices. Okay, the cost that is incurred in the increased process of production is shifted, the burden is shifted onto the consumers. Clear? Now, the another type of inflation is the imported inflation. Imported inflation is nothing but if there is a depreciation of the currency. If the depreciation of the currency, it means that if there is a decreased value of the currency, okay, due to market driven forces, the value of the Indian currency decreases. As a consequence of the decreased currency, the value of the imports or the cost of imports will increase. The imported goods and services becomes more expensive. So as a consequence of that, the domestic inflation might increase. For example, consider in the normal times $1 is equal to 80 rupees. Okay, now because of the depreciation, $1 has become 100 rupees. Okay, now I am importing this particular pen from the USA. Now in normal times, the price of this particular pen is $1. Now in the normal times, I will pay 80 rupees for this particular pen because of the exchange rate value $1 is equal to 80 rupees. Now as a consequence of the depreciation of the currency, for the same pen, I am forced to pay 100 rupees, which is nothing but the increased level of prices with respect to the particular pen and leading to the inflation. It is leading to the inflation. Clear? Next, structural inflation. Structural inflation. Because of the structure in the market or structure in the country, there is a increased inflation. The economic structure in the market is leading to the increased inflation, and that is what is called as the structural inflation. Structural inflation arises because of certain changes happening in the economy. For example, if there is a low agricultural productivity in particular year. Now as a consequence of the low agricultural productivity with respect to certain agricultural goods like onions and tomatoes, the prices of onions and tomatoes will increase, leading to food inflation. Clear? Next, speculation in commodity exchanges. Okay, speculation in market manipulation is also same thing. For example, even if there is increased produce of the agricultural related products or the most essential products, there is a concept called as hoarding or black marketing, where artificially the prices of certain goods are increased. Artificially the price of certain goods are increased so that the profits can be generated. Okay, the essential things will be stored, will be hoarded without them being available in the market, without making them be available in the market, and that is leading to the speculation. Next, speculation in commodity exchanges. For example, it is the uncertainty or manipulative trading in commodity markets that can drive prices upward. So it is a kind of the example of the same hoarding. Okay, next, cartelization. Cartelization is hoarding is with respect to one particular good. Cartelization is nothing but the set of goods. Manipulating the set of goods. Okay, when the producers conspire, when producers conspire to manipulate market prices for their own benefit, it's not one producer and one good, but it is set of the producers, they manipulating the set of goods over the time to artificially increase the price or to manipulate the market, is what is called as the cartelization. Okay, now the questions with respect to the demand pull inflation the demand pull inflation can be asked in such a way that what might create demand, what are the factors for the increased demand. Okay, and the question with respect to the cost push inflation can be asked, what leads to the increased production or increased cost of production with respect to a particular good. Okay, and also the imported inflation, how the depreciation of the currency will lead to the increase in the prices of goods, increase in the price of goods at the domestic level. And also the structural inflation, what are the structural things that might happen with respect to the increase in inflation, and also the cartelization, etc. Clear? Next, hoarding. Just now I have told you, the practice of stockpiling goods and releasing them during scarcity, leading to temporary spikes in the prices. Okay, artificially the commodity prices are increased. See, hoarding, cartelization, black marketing, etc. All these things are not. We have strictly, what you say, in order, we have been divided those topics into little subtopics for more detailed understanding. But at the end of the day, the ultimate agenda of the all the things is same. Okay, it is not because of the cost push, or it is not because of the demand driven factors, or it is because not because of the certain other factors the inflation is increasing, but it is the artificial factors. The artificial factors are leading to the increase in inflation. Clear? Now, what are the categories of inflation? The categories. The first one is the creeping inflation. Creeping inflation. Creeping inflation is nothing but the general price rises of around 4%. Why we have kept 4%? Because I have told you, according to the Urjit Patel Committee of 2014, we opined that, or we decided that 4% would be the optimum rate of inflation. 4% would be the optimum rate of inflation. That is what is called as the creeping inflation. Next, trotting inflation. The trotting inflation. Price rises between 4% and 8%. Price rise between 4% and 8% is what is called as the trotting inflation, the next level of inflation. Next, galloping inflation. If the trotting inflation, happens for the persistent time, then it ranges to 8 to 10%, which is called as the galloping inflation. Next, runaway inflation. Runaway inflation. This inflation is over 10% to 20%. Which is next is the hyperinflation, and once we enter into hyperinflation, it is very much difficult for the economy to be stabilized. Okay, so it is very difficult for the economy to be stabilized when it runs into the bracket of the hyperinflation. Clear? So here the question can be asked, what are the orders of inflations? The orders of the inflation from the creeping, trotting, galloping, runaway and hyperinflation. Clear? Next. Now, key terminologies related to inflation. First one is the stagflation. The stagflation. Stagflation is nothing but it is the system where there is a inflation and unemployment. There is an inflation, there is a increased prices of the goods, okay, but there is unemployment, okay, and this especially happens during recession. Okay, recession is nothing but the negative GDP. Recession is nothing but the negative GDP, and that negative GDP will lead to the unemployment, and parallelly there is a concept of the high inflation. There is a concept of high inflation, that is what is called as the stagflation. Next, disinflation. Disinflation is nothing but there is a increase in the inflation. There is a increase in the inflation, there is a increase in the general prices of the goods and services. Okay, but after certain point, because of the certain steps taken by the government, because of the certain steps taken by the RBI through monetary policy and fiscal policy, the level of inflation comes down. It increases and it comes down. That is what is called as the disinflation. Disinflation is nothing but a slowdown in the rate of inflation. A slowdown in the rate of inflation. Prices are still rising but at a slower pace. Clear? Next, deflation. Deflation. Deflation is nothing but on very first hand basis, the prices directly decrease. If the prices increase and decrease, then that is disinflation, and without increasing, if the prices directly decrease from the normal optimum level, then that is what is called as the deflation. And deflation can happen because of the less demand. Deflation can happen because of the less demand or the less purchasing power parity. Less purchasing power parity. Okay, as a consequence of the less demand or as a consequence of the less purchasing power parity, the deflation can happen. Next, reflation. Reflation. Okay, now reflation is like disinflation. When there is a decreasing prices because of the deflation, now the prices need to be revived or the prices need to be increased through the creation of the demand. That is what is called as the reflation. An increase in the price level aimed at countering deflation. And increasing the price level aimed at countering deflation, often following a recession. That is what is called as the reflation. Clear? Clear? So in this area, the question can be asked, what is the combination of stagflation? Okay, is it stagflation only recession? No, it is the unemployment plus the inflation. Next, disinflation, increase in the inflation and the fall down of the inflation. Okay. Next, reflation, directly the prices being decreased. And the reflation, reflation is nothing but the decreased prices are being increased by creation of demand. Clear? Next, the skewflation. Skewflation. Skewflation is nothing but it is the scenario where the prices of one or few commodities experience the price increase. Okay. So, it is a scenario where the prices of only selected goods or only certain goods increases over time, That is called as the skewflation. Inflation gap. Inflation gap is nothing but the spending of the government is more than national income. See, the government or the country as a income, okay, in the form of the taxation or in the form of the output and etc. Okay, national income is nothing but the overall output, the value of the total output is what is called as the national income. Now, as a consequence of this, if the inflation rising or if the amount that is being spent is more than the national income, then that is what is called as the the inflation gap. Next, deflationary gap. Deflationary gap is nothing but if the spending is less than the national income. If the demand is less, as a consequence of the less demand, if the spending of the country or if the spending of the the unit, considering the country as a unit, if the spending of that unit is less than its national income, then that is what is called as the deflationary gap. Next, inflation tax. It is the indirect tax on wages. It is the indirect taxes on wages. Okay, where rising prices lead to higher nominal wages, increasing tax liabilities and government revenue. If there is an increase in inflation, if there is an increase in the persistent prices of the goods and services, or if there is an increase in the general prices of goods and services, according to the inflation, the salary or the wage of the particular person also keeps on increasing. But the salary increases to a certain extent where now the amount is taxable or the percentage of the tax that is collected on the earnings is increased. As a consequence of that, the government generates more revenue in the form of the taxation, but in reality, it will not increase the affordability of the particular person. It will not increase the affordability of the particular person. Clear? Next. Inflation spiral. It is a spiral where rising wages leads to high prices. A wage spiral where rising wages lead to higher prices, which in turn causes wages to increase further. See, there is an increased circulation of money in the market because of, see for example, if my income is 1 lakh, okay, now because of the increasing inflation, my salary also increases. According to the necessities that I have, my salary also increases, but the inflation is increasing in such a way that again according to that inflation my wages also keeps on increasing. So it is a spiral, it is a cycle where the inflation is increased, as a consequence of that my salary increased, and again as a consequence of the salary increasing there is a increased circulation of money, and that will increase the inflation further. So it is a cycle, it is a cycle. Next, inflation accounting. Inflation accounting. Inflation is accounting is nothing but adjusting the financial statements. Adjusting the financial statements for the effects of inflation, for the effects of inflation to more accurately reflect true profits. Okay, to more accurately reflecting the true profits, the financial statements are adjusted to the inflation. The statements are adjusted to the changing level of prices. Inflation premium. The extra benefit borrowers receive from inflation as the real interest rate declines. Real interest rate declines. For example, let us consider a scenario where I have taken 1 lakh as loan. Okay, I have taken 1 lakh as the loan amount. Now the interest rate that is charged is the 5 rupees or 5% as interest rate. Now after 1 year I need to pay 1,05,000 totally as the amount. The principal amount is the 1 lakh. Now consider after 1 year there is a scenario of inflation, or after 9 months there is a scenario of inflation. Now as a consequence of the scenario of the inflation, the value of the money decreases. The value of the money decreases. Previously 1 lakh used to buy the certain set of goods, but now that 1 lakh amount has lost its value and it is not buying any goods and services. Okay, so the value of the money has decreases. As a consequence of the value of the money being decreased, it benefits the borrowers. It benefits the borrowers because the value of the money has declined. Now the 1 lakh might be equal to 10 lakhs, but still I have taken 1 lakh in the previous year, so I'll pay the same principal amount with additional just 5% of the interest. Clear? So that is what is called as the inflation premium. Next, the headline inflation and the core inflation. Headline inflation and the core inflation. See, core inflation is nothing but core inflation is nothing but it is the inflation rate where the certain volatile items are excluded from the calculation of inflation. What the volatile items like the food, fuel, etc. are excluded from the total calculation of the inflation. That is what is called as the core inflation. Next, the headline inflation. It reflects the overall inflation including all goods and services. Okay, it does not exclude any goods and services. It reflects the overall inflation. It includes the volatile items, includes the items like fuel, the food, etc., giving the total picture or the total calculation of the inflation. Clear? Next. Now in this area the question can be asked most common areas are the headline inflation and the core inflation. These areas becomes very important as far as the UPSC examination is concerned. Clear? Next. Now effects of inflation. Effects of inflation. This is very important. One, on creditors and debtors. On creditors and debtors. First thing, as we have discussed in the previous slide, lenders lose because the real value of repayment decreases. Yes, because when the value of the money decreases, when the value of the money decreases, the borrowers benefits. The borrowers gets benefited, but the lenders are on the loser side. Clear? Clear? So the borrowers gets benefited because they are repaying the money which really do not have any value. Okay, previously that money used to buy certain set of goods and services. Now that money doesn't have any value. It became cheap. It became, what do you say, inoperative. So as a consequence of that, the borrowers gets benefited. Clear? And the very short term basis, on very short term basis, there might be increased demand which can stimulate the production and boost investments. Let us consider a scenario like this. Now there is a inflation, there is a increased price of goods and services because of the increased supply of money in the market. Now because of the increased circulation of money in the market, there is a increased demand. Okay, now to match that demand, the companies are investing a lot in their sectors to boost the production so that the demand can be met through supply. Okay, for example, if there is a increased demand for the mobile phones. Okay, now the production companies will invest additional amount in the, what do you say, the sector of mobile phones to match up the demand, and that demand has arisen because of the increased supply of money in the market. Clear? But in the long run, the high inflation erodes the purchasing power, leading to the reduced savings and potentially low investments. For example, let us consider a scenario where in the long run, it's not in the short run, but in the long run, there is a persistent inflation. Okay, now I have been earning 1 lakh. Okay, and my, according to the inflation, my salary has increased to 1,50,000. But over the time, my salary remained the same, but inflation kept on increasing. Now I need to pay additional amount which I used to save in the banking system to meet my expenses. Okay, the amount that is what do you say, saved in the banking system need to be spent to meet my expenses. Clear? So as a consequence of that, the saving rates has been decreased. The savings rates have been decreased, and that will lead to the more decrease in the investments. More decrease in the investments, because investments are the source. Okay, banks are the source of the investment to majority of the sectors. Now if there is no availability of the money in the bank, if the savings rate has been decreased because of the rising inflation, obviously that will affect the entire system. Clear? Next, now what is the effect on the savings? What is the effect on the savings? Now, initially in the short run, savings may initially increase. Savings may initially increase because the banks might say that instead of spending, you deposit the money in the banks, we will earn higher interest. We will give you higher interest. That is on very short term basis. That is very short term basis. Okay, if there is what is availability of money in the market, and to squeeze that amount from the market, what does the banks do is that they will encourage, or they will ask the people to deposit that money in the bank so that it will increases the savings rate. Okay, but in the long run, the real value of savings also decreases. The real value of the savings also decreases because the value of the money by itself is decreasing. The value of the money by itself is decreasing. So as a consequence of that, the value of the savings also will decrease. Clear? The what do you say, the percentage of the savings might increase, but the real value of the savings, real value of the money will decrease, because down the line the inflation has been increasing to such an extent that it really does not have any what do you say, the value of the money. Clear? Next, taxation. On taxation, indirect taxes can rise as the cost of goods increases. I have told you in fiscal policy, the effect of the taxation or the effect of the taxes is nothing but, if the inflation is high, there might be more, that might be because of the more indirect taxes. Okay, if you want to decrease the inflation, you need to decrease the indirect taxes. Okay, why? Because indirect taxes are added to a particular product. Now decreasing the indirect taxes will bring down the level of price of that particular good. So indirect taxes need to be decreased. Okay, and the direct taxes need to be increased because there is a increased circulation of money in the market. That increased circulation of money need to be brought down by increasing the direct taxes. So indirect taxes can raise the cost of goods increases. Yes. Direct taxes may increase if nominal income rises, because when the direct taxes are increasing, the level of the circulation of money decreases. That leads to decrease in inflation. Clear? Next, the effect of the government revenue. The effect of the government revenue. Now, the government revenue, the nominal tax collections may rise with inflation through real value may suffer. The nominal tax collections may rise with inflation, though the real value may suffer. It means that as inflation is increasing, your wages increase. As your wages increase, the amount of the tax that is collected on you also will increase. Okay, according to the inflation, the wage increases means it doesn't mean that you are given the option of not paying the tax, or the tax collections are relaxed. No, it is not such a way. Clear? And the effect on the exchange rates and trade. A depreciating currency due to inflation boosts exports. How? How the depreciation boosts exports. For example, the value of $1 is equal to 80 rupees. On very normal day, the value of $1 is equal to 80 rupees. Now, because of the depreciation of the currency, $1 has become 100 rupees. $1 has become 100 rupees. Now, as a consequence of this particular system, previously for 1 pen, I used to pay 80 rupees. That is $1. Now, because of the depreciation of the currency, because of the currency losing its value, for $1, for 1 pen, I am paying 100 rupees. Where it means that because of the depreciation, the value of the particular product has increased. The value of the one particular product has increased. This is with respect to the imports. If I am importing from one country, then obviously during depreciation, the imports become costlier in such a way. Now let us talk about the exports in the same context. Okay. Now for $1, these, what do you say, the foreign people, okay, they are getting one apple. Okay. Now for the same $1, they are getting 2 apples now, because of the currency depreciation. Okay. So as a consequence of that, the exports increases. The exports increases. Clear? Next, on employment and wages. Okay. Employment may rise in the short term but fall in the long run. How the employment increases? There is an increased demand. There should be increased supply to meet the demand. So as a consequence of that, there is more investment, and that will lead to more employment. But this is very short term basis. This is on very short term basis. Okay, and the effect on the wages also. The effect on the wages also. Initially, the nominal wages might rise, but over the time, even if the wages increases, the real value or the real power of the money decreases. But the real purchasing power could decline, because the money is losing its value. When the money loses its value, even if your salary increases or even if your wages increases, it cannot supplement or it could not afford you the basic goods and services. Clear? Next. Now, inflation indices and measures. Inflation indices and the measures. The first one is the wholesale price index. The wholesale price index. Wholesale price index measures the price changes at wholesale level. Wholesale level. For example, wholesale level is nothing but if this is the point of manufacture. Okay, now this is the retail shop. Now after retail shop, the consumer purchases. Now this entire supply chain management is what is called as the wholesale level. Now the prices can be changed in this what do you say stages due to different factors. For example, if there is increased transportation cost, if there is increased what do you say the indirect taxes that are applied, then obviously the prices will vary and the final prices will are reflected here. Clear? So this wholesale price index, it is the measure changes, price changes at the wholesale level, that is the before the retail level, before the retail level. It is complied by the Ministry of Commerce and Industry. Okay. Comprises groups such as the manufactured goods, primary articles and fuel and power. Now within these three groups, we have the larger share of the manufactured goods. Larger share of the manufactured goods. That is one point. The another point is that the wholesale price index does not include the services within it. It does not include the services, the changing, what do you say, the prices of the services. Next, the consumer price index. Consumer price index is nothing but this, the changes in the prices or the scenario after the retail or from retail. From retail. Now, it tracks retail prices changes for a definite group of consumers. Why we are saying it is for the definite group of consumers? Because the group of consumers or the salaries or the affordability keeps on changing according to the sector of consumers. That is the reason because of which for consumer price index, we do not include it as one sector or we do not treat everyone as equal. Clear? Now, prepared on rural, urban and combined basis. Rural, urban and the combined basis. Okay. Now, we do have the four types of CPI. That is the CPI for industrial workers, CPI for agricultural laborers, CPI for rural laborers and the combined CPI. The combined CPI. Clear? So, the sector of the workers or the sector of the people are divided according to their availability, affordability, point number one, and according to their areas, whether it is rural or the urban. Next, GDP deflator. GDP deflator. GDP deflator is nothing but it compares the nominal GDP to the real GDP. Nominal GDP to the real GDP. Okay. So it is the implicit indicator. It is implicit indicator that gives you the idea of what are the price changes. What are the price changes in the regular intervals over the year. In the regular intervals over the year. Over the particular year. Clear? Next. So, within the GDP deflator, the goods and services are included. I have told you, in the case of WPI, the only goods are included, the services are not included. Whereas in the case of CPI and in the case of the GDP deflator, the both goods and services are included. Next, the producer price index. Now the wholesale price index, it calculates from the manufacturing sector to the retail sector, but the producer price index, it also calculates the things before manufacturing. The how the cost of raw materials affects the cost of manufacturing, how the cost of the increased wages will affect the cost of manufacturing. So it includes both output prices and input prices, that is the entering production or the raw materials. Okay, and as a consequence of this, as a consequence of it including the every stage within the output and the input mechanisms, it will have the clear idea or it will give you the clear picture more than the WPI. Clear? Next, base effect. See, base effect is nothing but it refers to the impact of comparing current prices changes with a period of unusually low prices with the high prices or the inflation Okay, the years of the low prices and the years of the high prices are combined, have been, what do you say, calculated, and according to that the base effect is given. Clear? See here, as a concept of the producer price index, one thing that you need to remember is that you need to remember it in the context of what exactly is the difference between the producer price index and the WPI. This is very important. Next. Now, inflation targeting and the monetary policy. Inflation targeting and the monetary policy. Okay. Now, when we have discussed the monetary policy, I have told you one thing. According to the Monetary Policy Committee, or according to the Urjit Patel Committee that was appointed in the year 2014, okay, the Monetary Policy Committee aimed at the 4% rate as of inflation as the optimal rate. The 4% of inflation rate is the optimal rate of inflation. Why? Because according to the Monetary Policy Committee, the 4% of inflation is feasible to India, and that level of increase of prices is essential. Clear? So, but there is a relaxation. There is a relaxation of plus or minus 2% that we have given the to, what do you say, the inflation rate. Why? Because it cannot decrease beyond 2% and it cannot increase beyond 6%, which is not good for the economy. Okay, I have explained you why the excessive deflation is also not good for the economy, and excessive, what do you say, the inflation is also not good for the economy. Next, Monetary Policy Committee. Monetary Policy Committee. Monetary Policy Committee, it is the institution that was set up by the RBI for the targeting of the inflation, to target the inflation, to achieve the optimum level of the inflation targets. Clear? So here the question can be asked, what is the percentage? Point number one. Point number two, the question can be asked, what is the duty of the Monetary Policy Committee with respect to achieving this percentage? Clear? Next. Now, what is the composition of the Monetary Policy Committee? It consists of 6 members. It consists of 6 members. 3 RBI officials, okay, and 3 nominated members, 3 external members by government. Clear? And the RBI governor acts as the chairperson with a casting vote. Casting vote, because there are 3 plus 3 members and there can be a tie, and in the case of the tie, the casting vote is given by the RBI governor. Clear? Now the mandate. Currently the committee aims to maintain annual inflation of 4%. Annual inflation of 4% with an upper tolerance of 6% and lower tolerance of 2%. Okay, it is 4% plus or minus 2%. Clear? Let's move to the next topic, that is the banking system in India. Okay, now when you talk about the banks, first we need to understand what actually a bank is. What do you understand by the bank? Now, a bank is a financial institution. It is a financial institution that is authorized by the government to manage the deposits and to make the advances in the form of the loans and to provide the financial services. Overall, to provide the financial services. It accepts deposits from the customers. It accepts deposits from the people, and those deposits are rendered as loan those deposits are advanced as loan to the government or the private entities, and the interest rate that is generated out of this loan is the profit to the government, profit to the banks, and the deposits are catered to the people. Clear? So this is the basic function of the banks. Additionally, banks provided services such as the checks, drafts and other easy payment and withdrawal facilities. It's not just the payment through cash or etc. The diverse form of payments, the diversified form of payments are part of the banking system. Clear? Next. And when you talk about the banks, the one thing that you need to remember is that the deposits are the liabilities to the bank. Okay, the deposits are the liabilities to the banks, and the loans are the assets. The loans are the assets. Why? Because it is on this particular loan the interest rate is generated, and that interest rate is the profit to the banks. Clear? Now, let us, before going into the detailed system of banking, before going into the detailed system of banking, let us also understand what is the non-banking financial companies are. They might seem as providing the services of the bank, but literally not, they do not come under the, what do you say, the concept or the definition of the bank. The concept or the definition of the bank. For example, NBFCs are financial institutions that provide financial services similar to the banks but with certain limitations. They are given certain limitations. The first one is the NBFCs do not accept demand deposits. You cannot deposit the money. You cannot deposit the money like how do you deposit in the banking system? In the formal financial system, you have the option of depositing your money. But whereas in the NBFCs, you do not have the option of depositing the money. That is the first thing. Since they are not part of the payment settlement system, they cannot issue checks. Okay, when there is no deposits that are accepted, or when there is no facility of the deposits, obviously the facility of the check also will not be present. Okay, and deposits with NBFCs are considered unsecured as they are not covered by deposit insurance. Okay, on first hand level, deposits are not encouraged, and on the second level, even if certain kind of deposits are encouraged, they are not secured. They are not secured because they do not have the insurance. The insurance mechanism to the NBFCs is not provided as per the what do you say system within the NBFCs. Clear? Next. The concept of, now let us come into the very core concept of the banking system. The first one is the nationalization. The concept of the nationalization. Now, what do you understand by the term nationalization? Nationalization is nothing but when the authority of the particular institution is controlled and regulated by the government. Okay, if the authority is taken over by the government, that is what is called as the nationalization of the system. Okay, now within the banking system, the process of bank nationalization played a crucial role in shaping the Indian banking sector. Okay, initially in 1949 the RBI was nationalized. In 1949 the RBI was nationalized. Later in 1955 the State Bank of India was formed by merging three imperial banks. Previously, we used to have the three imperial banks or the presidency banks, and those banks were integrated or were merged to form the State Bank of India. And very famous, we know, in 1969, 14 major private banks were nationalized. 14 major 14 major banks were nationalized. Clear? Next, the second phase of nationalization occurred in April 1980. Where 6 more private banks were brought under the government control. See, the nationalization that happened in the year 1969 and the nationalization that happened in the year 1980 are very important because they have created the mechanism of the credit access in the rural areas. The nationalization of the private banks in the year 1969 and 1980 have created the provision of the credit access in the rural areas. That is the reason because of which the nationalization of the banks become very important. Now, the possible area of question in this slide would be the year of the nationalization, the advantages of the nationalization, okay, or the what do you say, how many banks have been nationalized in the year 1969 and the second phase. Clear? Next. Now, benefits of bank nationalization. First one, it reduces the monopoly. The dominance of the private players will be reduced by, because now the government regulates the system, and or the central bank, that is the RBI, will regulate the system. Next, as I have told you, there is a improved credit access, because if the banks are nationalized, the profit oriented mechanism of the private banks are regulated. The flow of the credit is regulated. As a flow of the credit is regulated, obviously government the banks need to allot certain percentage of its income for the, or certain percentage of its loans to the key sectors. For example, you have the priority lending system, where certain key areas are identified by the government, and now the banks need to allot certain loans to these key areas. Clear? Next, expansion of banking services. Okay, the nationalization will allow the branches in operate in rural areas. It allow the banks or the new branches to operate in the rural areas. Clear? So, as a consequence of this, the financial accessibility will improve, and also opening the banking services in the rural areas will also promote the financial inclusion. Next, financial awareness. Increased banking service in rural areas raise financial literacy. Okay, next, that is exactly what is called as the financial inclusion. Next, priority sector lending. See, priority sector lending is nothing but the certain key areas are identified by the government. Now, the banks are regulated in such a mechanism that the bank need to cater the services or cater the loans to those key areas. Okay, for example, agriculture, the MSMEs, or the weaker sections, the catering loans to the weaker sections, or the what do you say, the education, etc. They are identified as the priority sector lending. Clear? Next. Clear? Next. The drawbacks of the bank nationalization. The first one is that there is a decrease in profitability, because now the banks need to function according to the guidelines of the RBI. Now, as we discussed in the monetary policy, what are the instruments of the monetary policy? We have the cash reserve ratio, we have the SLR, etc. The reserve requirements, Now, the banks are forced to meet the reserve requirements. The banks are forced to meet up the reserve requirement. As a consequence of this meeting the reserve requirements, the profitability will decrease. You need to pay the cash reserve ratio. You need to maintain the certain, deposits in the form of the SLR. That might pose a challenge to the profitability of the banks. Next, the overstaffing. See, the rapid expansion of bank branches resulted in excessive staffing, making the operations economically unviable. Okay, excessive staffing means excessive salaries. If banks are made to operate in the rural areas, see, the banks need to operate in the rural areas. It's not that we are against the concept of the rural infusion of the banking system, okay? But the concept here is that when there is a rural expansion, you should be less profit oriented, okay? Because in rural areas, the banks might not generate any profit to its, system. So, as a consequence of that, the rapid expansion of the branches into the rural areas might lead to the less profitability. Again. Okay. Next, increase in bad loans. Nationalized banks witnessed a surge in non-performing assets. Non-performing assets. It is because of the government interference. It is because of the lack of the discipline within the banking system. Over the time, the non-profitable or non-performing assets, the rate of the non-performing assets has considerably increasing, which is creating stress on the banks and leading to bankruptcy, creating the stress and leading to the bankruptcy. The banks are forced to close its operations, or banks are forced to close its functions because of the, what do you say, the lack of the income or the lack of the mechanism to recover the loans from the different people. Clear? Next. Political influence. This is very obvious. Banking system is misused for political gains. For example, best example is the loan waiver. The loan waiver. The loan waiver schemes has led to the decreased profitability or the increased interference. Increased interference. Okay, next. Decline in customer service. Decline in customer service. The service quality that is provided to the customer has decreased. Okay, the efficiency has decreased because now the banking system has become more or less a, what do you say, the job which has more consistency, which has more guarantee as a for a particular employee. So as a consequence of that, the efficiency has decreased. Clear? Banking sector reforms. The banking sector reforms. See, the main aim of the banking sector reforms is to improve the financial stability. The financial stability and the operational efficiency. Okay. So, in order to improve the financial stability and the operational efficiency of the banking system, many reforms have been introduced. Now, what are those reforms? The first one is the Narsimhan Committee. The Narsimhan Committee. Now, the Narsimhan Committee recommended strategies to restore the financial health of the commercial banks. The financial health of the commercial banks and enhance their efficiency. Enhance their efficiency. Now, what are the key recommendations? The first recommendation is reduction in CRR and SLR to allow banks to utilize funds for agriculture, industry, and the trade. Okay, the amount of the compulsory CRR and the percentage of the compulsory SLR need to be relaxed so that the excess funds or the available funds with the banks can be utilized as an provision of loans to the key sectors like the agriculture, industry, and the trade. Clear? Next, introduction of prudential norms by the RBI. The prudential norms by the RBI to promote professionalism in banks. Professionalism in banks. And this include the classification of the assets, the income disclosure, and the provisions for bad debts. Clear? See, within the banking system, these three areas becomes very important. The classification of the assets, the proper income disclosure. See, if there is no proper income disclosure, obviously we do not understand the track or the status of the performance of the banks. Suddenly, one day you might read in newspaper that there is a collapse of the banks and there is a bankruptcy with respect to one particular bank. That is the reason because of which the RBI wants to be the watchdog of the banking system, and that need to be done by prudential norms of the RBI. Clear? Next. And also to control the NPA, rising the non-performing assets. That also need to be, what is regulated by the RBI. Next, the capital adequacy ratio. What is capital adequacy ratio? Capital adequacy ratio is nothing but money to weighted assets. Okay, the liquidity to weighted assets. Okay, the amount of money that you have in proportion, or the capital that you have in proportion to the risk weighted assets. Okay, so you need to have the enough liquidity with the system. The banks need to have the enough liquidity with itself so that the things can be regulated. If there is any crisis with respect to the banking system, that crisis can be tackled by this risk-weighted assets. Clear? Next. In April 1992, RBI set the capital adequacy ratio at 8%, which was revised to 9% for scheduled commercial banks and the 12% for public sector banks. Why it is 12% for the public sector banks? The reason is that the public sector banks have the high amount of non-performing assets. The non-performing assets, the percentage of the non-performing assets is high in the public sector banks, and that is the reason because of which the public sector banks has been imposed or has been regulated to maintain the 12% of CAR. Next. Deregulation of interest rates. Deregulation of interest rates. The banks need to be given the freedom to regulate their own deposit interest rates based on market conditions. It's not that RBI should be the strict watchdog or RBI should be the strict promoter of the banking system. No, the certain reforms need to be taken in such a way that the independence should be given to the banks or the freedom need to be given to the banks. Clear? Next. Again, we have the Narasimhan Committee in the year 1998. Apart from the first commission, we have the Narasimhan II Committee in the year 1988. Now, the aim is to review the progress of the banking reforms and design measures to further strengthen the financial system. We have taken up the banking reforms previously, that is the Narasimhan I Committee, and we have taken the reforms again so that the previous reforms can be strengthened and revived. Clear? Okay. Now, what are the key recommendations? Merger of major banks. See, merging of the banks lead to the consolidation of the banking system. Okay, for more financial stability, risk integration, the merger of the banks becomes very important. Okay, if the banks are not merged and if it is divided into certain individual systems, obviously there is more risk associated with it. The merger of the banks will lead to the more financial stability and the industrial growth. Next, introduction of narrow banking concept for banks with high NPAs. Okay, so narrow banking concept is nothing but allowing the banks to invest in the short term and risk-free assets. The risk-free assets, the assets which are not long-term in nature, which are not risk. See, as the asset is long, as the asset has the long tenure, obviously the amount of the interest rate that is charged on that particular loan or whatever it is will have more percentage. But in the long run, it might be cleared or not. Okay, that is the reason because of which in India, with respect to public sector banks, we have the high NPAs. Okay, so if the system is long, if the loan tenure is short term in nature, obviously you will have a guarantee that that can be recovered in the next 3 months or the 6 months or 1 year. Clear? Next, recommended increasing capital adequacy norm to strengthen the banks. Okay, the same capital adequacy norms that we have in the the capital adequacy ratio that we have in the Narasimhan I Committee has been recommended again. Suggested revising governance laws such as the RBI Act, Banking Regulation Act and Banking Nationalization Act to align with modern banking needs. Okay, so that is the reason because of which at one point of time I have told you the RBI has eased the condition of the interest rate that banker caters to the depositors. This is one reform. This is one reform where the profit of the banks now is being given or is being catered to the depositors, which is again a reform that has been brought under the Narasimhan Committee. Next, emphasized faster computerization, technology upgradation and staff training. There should be a technology infusion. There should be a technology infusion into the banking system. Okay, that is the aim. Next, recommended depoliticizing banks to reduce political interference and improve professionalism. See, the political system has become in such a way that it is interfering the banking system. For example, there is this concept called as loan waiver, which we have discussed previously. Now the concept of loan waiver is leading to the reduced efficiency in the banking system. Now that is not good for the banking system in the long run. Clear? So these are the recommendations of the Narsimhan 2 committee. Clear? Next, the Nachket-Moore committee. The Nachket-Moore committee, which was appointed in the year 2013. The Nachket-Moore committee, it focused on the financial services, providing the financial services for the small business and low income households The focus was more on the small business and the low income households. Okay. See, generally the small business and the low income households are typically or more situated or more located in the rural areas. Okay. So for the development of the low income groups, especially in the rural areas and also in the urban areas, this particular committee made certain recommendations. And the first thing is that it suggested providing a universal bank account to all Indians above the age of 18 by January 2016. So, any person who is above the age of 18 years shall have the universal bank account according to this committee. Next, advocated for vertically differentiated banking system. It means that when there is a vertical arrangement of the banking system, there should be a differentiation or there should be a branching of the banking system. It need to be divided into certain groups. The first one is the payment banks. Now, the payment banks will be formed in order to facilitate the deposits and the transactions. More amount of the transactions. Okay. Next, we have the wholesale banks for credit outreach. See, the very meaning of the term wholesale banks is nothing but where the loans will be given to the large corporate or the loans will be given to the corporate or the institutions which are having the large amount of transactions. When the amount of transaction is more, when the amount of the transaction is large, then that can be facilitated through the wholesale banks. Next, he emphasized on the Aadhaar as the key driver. Okay, the Aadhaar need to be linked to the banking system. The Aadhaar need to be the key driver within the banking system, so that the irregularities or the transaction can be tracked easily. So the Aadhaar number, which is generally linked to the which is used as the medium for all the government beneficiary programs, the same way the Aadhaar need to be the key driver for the banking system. Clear? Next, proposed district level monitoring of deposits and advances. The district level monitoring, the decentralized monitoring should be the mechanism at the district level, so that the deposits and the advances can be compared to the GDP. If there is any inconsistency, then according to the inconsistency, the steps can be taken up by the respective bank or the respective system. Clear? Next, introduce the concept of universal electronic bank account. Universal electronic bank account will give you the feasibility of the electronic transactions. electronic transactions. Now, when the electronic transactions are facilitated, then it need to be secure and it need to be, what do you say, prevented from all kind of irregularities or etc. And that would be the mechanism that is provided as part of the universal electronic bank account. Okay, so for the safe and the secure transactions, we need to have the digital platform, that is the UEBA, universal electronic bank account. Clear? Next. Now, PJ Naik Committee. PJ Naik Committee, it was appointed in the year 2014. Okay, and the main aim of the PJ Naik Committee is to review the governance of bank boards. The governance of bank boards. Okay, so now the key recommendations are suggested converting public sector banks into companies under Companies Act. Okay, the PSB is under Companies Act. Now, what is the advantage? See, the point here in India is that the banks are always considered as an institution that functions for the welfare of the people. Okay, which is true. The banks need to function for the welfare of the people, but it is a financial system. For the financial system to sustain, it need to be under profits. Okay, it need to generate the profits. Without generating the profits, you cannot have the money to spend for the welfare of the people. Okay, so that is the reason the primary agenda of the banks, apart from welfare, also need to have the certain profits or need to have the activities which generates certain profits. So that is the reason it need to be treated as a company. It need to be treated as a company where the profit generation should be allowed, the deregularization should be provided. Okay, so as a consequence of that, it will generate the profits. It will generate the profits. Okay, now for that purpose, there is a bank investment company that is created to hold the government stakes in PSBs. Okay, the bank investment company will look after or will regulate the stakes or the, what is the share of the government in the PSBs. Now, as a consequence of that, the bank investment company will have the authority to control the PSB boards, because when they have the highest government, when the government has the highest stake, obviously that stake is held by the a bank investment company, and as a consequence of that, they will be given the authority to control the public sector bank boards. Clear? And also it advocated for proportional voting rights for all shareholders and reducing the government stakes to 40%. This is also very important. Okay, the proportional voting rights will be given to the shareholders according to the shares that they are holding, and majority of the stake, okay, majority of the stake, or what do you say, the government stake will be reduced to 40%. Why the government stake is being reduced to 40% is that when there is involvement of the private players, when there is involvement of the private channels into the banking system, obviously their motive will be for the profit generation. Okay, they will bring the ideas of how to generate the profits so that the public sector banks will sustain. It is not that we are completely giving a, what is a field for the private players. No, the government also will hold its securities or will hold its stake in the PSB, so that there is a participation of the government and also there is a participation of the private players. Next, emphasized appointing bank CEOs and top executives through Bank Board Bureau. Okay, the bank CEOs and the top executives, the appointments of the bank CEOs and the top executives are also, what do you say, looked after the bank investment company. Clear? Next, Basel norms. This becomes very important in the banking system. The Basel norms are the key drivers. Okay, the recommendations made by the Basel norms are the key drivers of the banking system. Okay. Now, the Basel norms are nothing but they are the recommendations made by the Basel Committee on banking supervision. Okay. So, the ultimate aim of this Basel norms is nothing but to ensure the financial stability. Okay. The credit risk or the areas of credit risk are the areas of focus for the Basel norms or the what do you say the Basel norms on the banking supervision, and those areas will be corrected. Okay. So, the primary focus is on credit risk. The primary focus also was on the credit risk. In fact, the capital adequacy ratio, the concept of the capital adequacy ratio that we have adopted as part of the Narasimhan 1 committee and the Narasimhan 2 committee are the what do you say recommendations made by the Basel norms. Okay. So, established a minimum capital adequacy requirement of 8%. That is the minimum. Okay. But in the case of India, we are following the 9%, 10%, and in fact, in PSBs, the public sector banks, we are following up to 12%, so that the increasing NPS can be reduced. That is one thing. And even if there is an increased amount of NPS, that can be managed by the bank system alone by maintaining adequacy, by maintaining adequate capital requirement. Clear? And also this is the Basel 1 norms. Next, we also have the Basel 2 norms where the banks need to maintain a minimum capital adequacy ratio of 8%. That is the that is a one provision. Introduced improved risk management techniques. Improved risk management techniques. What are those techniques? Not providing the long-term loan. Yes, the long-term loan will create more revenue. The long-term loan will create more interest. But if there is a bankruptcy that might lead to, or if there is a increasing number of NPS, then the banks or the system of the financial institution should focus on the short-term loan or the what do you say the areas of no risk at all. Okay. So, if there is a short term loan, for example, if the company is coming to me, if there is a company that is coming to me, now what do I do is that I being the bank, what do I do is that I will check the performance of the company in the previous years. Is it a profit generating company? Okay. Is the credit worthy of the company is good, or if there are any pending loans that the company is having, etc. All these are the scenarios that I usually do check upon. Now, when I try to provide the long-term loan of 5 years to 10 years, then obviously I will not have an idea of what would be the future of the company. Now, that is where that is what the reason because of which the banks are having the higher NPS. Now, if I provide the short-term loan of 1 year or 2 years, I know the performance of the company. It will not immediately collapse. So, as a consequence of that, it is better for me to provide the short-term loans. Clear? Next, mandate banks to disclose their risk exposure and maintain transparency. Okay. It is not that the banks will be completely opaque in nature. It is not that their information is not disclosed. The information of the banks, the accounts of the banks, the rising NPS of the banks, the profits of the banks, all they need to be disclosed. They need to be open. That is the reason because of which it is because of this provision now the RBI in India is having an idea of what is the financial performance of the particular bank, and that is the reason because of which if there is any bank which is not performing good, the prompt corrective action, the PCA, the prompt corrective action methods are used against the bank so that the financial health of the bank can be revived. Clear? So, here the areas of question can be the capital adequacy requirement. Okay. Next, what is the main aim of the Basel norms and etc. Clear? Next, Basel 3 norms. Basel 3 norms. It is because of the 2008 financial crisis. It is because of the 2008 financial crisis, we have come up with this another set of recommendations by the Basel III, the set of recommendations. Okay, so this particular Basel III norms, it aimed at making banks more capital intensive. More capital intensive. It means that they need to have the availability of money. They need to have the availability of money with them. They need to be capital intensive. They need to focus on those areas which can generate the capital to the banks. Okay, so that is one area, and they need to be resilient, or they need to be immune to any external shocks. Something happening in other country, some scenario happening in America should not affect our banking system. Okay, our banks need to be immune and resilient to the external shocks. Okay, so how can we be immune? By maintaining or being capital intensive. Next, focused on four key areas. Four key areas. They are the capital, having more amount of money, leverage, okay, how we are, on what criteria are we giving the loans, funding, okay, in what areas is the government generating its profit, and the liquidity, okay, how well it is managing the liquidity in the market. These four areas have become key pillars in the banking system according to the Basel III norms. Next, and also RBI has progressively implementing the Basel III norms in the form of being the intensive or being the capital intensive. Okay, providing the what is say following the key pillars, balancing the all the key pillars. Okay, and creating demand through the infusion of the money in the market. Okay, to a certain extent, it being capital intensive, it is trying to infuse the currency, or it is trying to infuse the money, okay, into the market, inject the money into the market. Clear? Next, now the capital adequacy ratio. Capital adequacy ratio. ఓకే, దిస్ ఈజ్ నాట్ రిక్వైర్డ్. ఈ స్లైడ్ అవసరం లేదన్న. ఓకే, ఫార్ములా సేమ్ అవసరం లేదు. నెక్స్ట్, ఇది ఎడిట్ చేసేయండి. ఓకే, నెక్స్ట్, ద మార్జినల్ కాస్ట్ ఆఫ్ ఫండ్స్. The marginal cost of funds based lending rate, we call it as the MCLR rate. MCLR. Okay, see, the MCLR system determines the minimum interest rate that a bank can charge on its customers. Okay, it is the minimum interest rate. Okay, now below that it should not charge. Okay, for example, if the minimum interest rate is 4%, now it should not decrease itself to 3.5% or 3%. Okay, so this is the minimum rate. Okay, now that minimum rate is completely based upon the market rates. Okay, so if there is a more amount of money that need to be induced in the market, that need to be provided in the market, then the MCLR will be brought down. Okay, now if there is no need, then the loans are made costly. The loans are made costly. Okay, next, banks revise their MCLR rates monthly based on the repo rate and other borrowing cost. Okay, clear? So based on the repo rate and the other borrowing cost, the MCLR also change. Okay, next, MCLR ensures fair interest rate and better transparency in lending practices. Yes, why? Because MCLR is one mechanism through which where the interest rate is charged on the customers, and if the interest rate is bringing down, as I have told you earlier, if the interest rate is being brought down, it means that that interest rate is brought down because of the changes in the repo rate and the other borrowings. Now, if the rate is increased, then also it will be reflected in the the repo rate and the other borrowings. So, as a consequence of that, every mechanism that happens with the RBI and the banks happens between the banks and its customers. Clear? Next. Now, why the MCLR system was introduced? Okay, so the MCLR system was introduced based on the repo changes. Okay, now the MCLR, the benefits of MCLR. For example, consider there is a repo rate. Okay, now the banks have taken the money from the RBI with respect to the repo rate. Now, the banks has taken the money from the RBI at the rate of repo rate. Now, if the repo rate is decreased, it means that the banks will have the more amount of money. Now, when banks are borrowing that money, or sorry, when the banks are lending that money to the customers, then that changed interest rate between the RBI and the banks should also change the interest rate that the banks are giving to its customers. Okay, so every change that happens in terms of the repo rate between the RBI and the bank should be reflected between the things that are happening between the banks and the customers. That is the reason because of which the MCLR was introduced. The benefits of the transaction, the benefits of the changes in the repo rate between the banks and the RBI should be reflected between the banks and the customers. Clear? Next. Okay, so this is with respect to the banking system. Thank you.